Well, good morning, everyone. Thomas Montgomery. Today is Wednesday, August 13th, 2025. We get together most weekday mornings, talk about strategies, tips, share techniques, success stories, and support each of you. My screen should be shared in the background. We have the nonprofit website, 509pacific.org, and then we'll have our notes screen here to go through. As a 501c3 nonprofit, we applied for and received a grant. And with that, there are three mandates or three aspects that we're expected to address. And frankly, these morning Zooms are specific to number one. We're expected to help build financial literacy, not generic theoretical information, but really practical. And I think today's discussion will meet your expectation and the grant mandate on that. Secondly, we give away free shelf corps, and there is a processing fee, but you determine what that is. And that provides that foundation so small businesses can pursue funding, because we do need a fundable business to get business funding. And then thirdly is to take that knowledge, take those shelf corps, and really inject money into the pockets, into the bank accounts of entrepreneurs so they can start and grow businesses. So our agenda today is to make sure you're familiar with the website. It's just one of the requirements. We have to check the box. So again, 509pacific.org, information about quick cash on top. There's a training video and a link to participate. From a business funding perspective of getting that free shelf corp and using it for funding, the middle of the page has that information. And then here at the bottom is if you're interested in becoming a distribution partner, information, trainings, and fill out the form. At the bottom, of course, it has our office phone number. In addition to that, we primarily use a support line for general run-of-the-mill texts or general run-of-the-mill questions, and that number is different. So this is an office line at the bottom of the website. This number is not answered live. It's just for texts. All right, what I really want to get into is a very practical conversation so you and I are on the same page. You and I can help any person get a large business loan, not through some strategy that's too good to be true, that's pie in the sky. We're going to talk about the basics. It's like a formula, right? Can anyone buy a home to live in for their family? Sure, if you meet the underwriting criteria of the given type of loan. Is it a VA, a USDA? So we don't want to go into it pessimistic thinking, oh, I can't get clients funding, or we can't get clients funding. We absolutely can. There's plenty of lenders that want to loan money to your clients, but the issue is the clients need to meet the underwriting criteria. So let's dig into that in a very practical way. So what's our topic? How anyone can get a large business loan. So the first thing, as we mentioned already, if you want business funding, you must have a fundable business. That sounds so basic, so elementary. I'm sure you can say, well, duh, of course. But a lot of people don't think that way. They want money, they need money, but they're overlooking the fact that they need to qualify for it. And that's where you and I play such an important role in educating what that means, and then of course getting them a shelf corp so they do have a fundable business to access funding off of. So there's a foundation of having a fundable business. So while there are different types of business loans, different types of lending options, it starts with a basic foundation that's pretty much needed in all cases. So regardless if they want SBA or an asset-based loan or whatever else it is, we need to start with the basics. And again, that's why we provide free shelf corps through the grant. It provides them those basics. So the basics, otherwise known as the foundational elements. So If someone wants business funding, not personal funding, but business funding, we're going to need to have a business entity that's in good standing. And what that means is that we're in good standing at the federal level with the IRS. That's where we get our EIN. At the state level, through the local secretary of state, needs to be in good standing. We do need to have a unique commercial address. And this is where a lot of people, they lack the literacy that you and I have, and that's why we need to teach. They think, oh, no, I'm just going to work from home. It'll be fine. Well, no one really cares where they work from, but we do need the business itself to be established with a unique commercial address, or we're not going to be successful with the capital raise. And we should have a business plan, both from an internal and external perspective. From an internal perspective, have we thought through what we're going to do, what goods or services we're going to offer, how are we going to make money, what are the expenses that we're going to incur, will it be profitable, and so forth. So that internally, that just makes sense, although many of us have an instinct just to wing it, I guess. We shouldn't. And then from an external perspective, not all lenders, but many lenders will want to understand, what do you do? And if we understand what the client does, then that will allow us to better understand the right type of funding, because based upon the wants of a client, the needs of a client, and their mitigating circumstances, we can use our lender match algorithms to find the right lender based upon those client specifics. So it may be clear to the client in their head, but we need to vet through that. And then we also need to have financial projections, same as a business plan. So from an internal perspective, I don't know that we would want to help a client go borrow a lot of money if they don't project to be profitable. If they can't pay it back, that wouldn't be a wise decision, although it's their choice. And then many, but not all lenders, will want to see financial projections. So one of the things that you and I always want to be on guard of is a lot of times people want to oversimplify business finance, and they'll ask questions as if there's only one answer, where really it usually depends. It depends on which lender and which loan program. Like, well, is a business plan needed? It's always good to have, but frankly, it depends. Some lenders, some loan programs want it, some don't. We have one lender we work with, they want a one-page business plan, and we know exactly what they want. Others want a full business plan. So just keep in mind, when it comes to underwriting, the answer is often it depends of the specific lender and loan program. But step one, you and I can easily help anyone accomplish this, because you and I give away free shelf corps. Again, I know you're going to charge them a processing fee. You determine how much that is, but they no longer have to pay the $10,000 that we used to charge for the shelf corp. So that's step one. Anyone have questions on step one, kind of that foundational element, the basis? Everybody good there? Okay, so then let's move on to where it gets a little more complicated. So let's get rid of that background sound if we can, possibly. Hopefully that'll stop. Maybe not. It's ringing in the background. Okay, well, let's move on. It'll stop in a moment. Sorry. All right, so step two comes down to the specifics. We need to start addressing the 3 C's. And we've talked about this many times and had basic educational content on this. When it comes to business lending, we need to be aware of the 3 C's, which includes credit, collateral, and capacity. Now, capacity means the same as like cash flow. So the 3 C's are very relevant. Now, as I just said, different lenders have different underwriting criteria. So it's not that we always need all 3 of them, but we need to be aware, at least to start with, this concept. In general, when it comes to business funding, we need to be aware of the 3 C's. Now, let's expand on that. If we're wanting to go after a traditional business loan, whereby it could be SBA or non-SBA, that really doesn't make a difference, but a traditional business loan, they typically look for these foundational elements, of course, but also they typically look for all three C's. And that's a little bit more complicated, isn't it? Because there's a lot to that. Is the business creditworthy? And sometimes they care about the business owner. Is the business owner creditworthy? Do we have adequate collateral for the loan? Do we have the ability to pay it back? Now, we work often with early stage businesses. So, in some instances, the capacity doesn't have to be demonstrated yet. We can show them projections and that can meet capacity. So, I'm not saying that a business already has to be cash flowing. Let's say that you and I want to start a restaurant. Well, if we need to get a loan to start a restaurant and we've not started the restaurant yet, of course, there is no capacity. There is no money coming in because we've not opened the restaurant. We've not been selling food yet. So my point is, in some cases, we can use projections to meet the capacity requirements. But of course, it's always even better to have a track record of money coming in. But capacity could be future looking or historical. Collateral is just, it's on paper, right? We're looking at the balance sheet of the business, maybe the PFS, the personal financial statement of the business owner. What is the client looking for? Which the use of funds is part of the business plan. So that's telling us and telling the lender how much money does the client want and what are they going to use it for. So collateral is a matter of fact, where capacity can be a little bit more projection based, as I mentioned. And then credit worthiness is usually measured by a credit report, whether it be a personal credit report of the business owner, if that's part of the underwriting, or business credit reports for the credit worthiness of the business. So traditional business loans like SBA loans are great, but it has the most rigorous requirements because it looks at all three C's. What I do need you to be aware of, and it's really our bottom line focus of our discussion today, is there are some options that only require one of the three C's. So I'm not saying it's better, but I am saying that it's different. So some lending options, traditional ones, typically require all three C's. I need to make sure that you're aware of that there's some options that we only need to have one of the three. And so obviously, if we only have to meet the underwriting criteria of one of the three, that's easier, quicker than meeting all three. So let's delve into that a bit more. So let's say that we have a client and they want to leverage just credit. They don't want underwriting to be concerned with their collateral or capacity. Well, one example is we can get business credit cards. That's not the focus of what we do, but certainly we can add business credit cards as part of a client's capital raise, or in some cases, if that's all that they want. We're still going to start with step one, so this all starts the same. But in some cases, business credit cards can either be their entire capital raise or part of it. Now, business credit cards often look at the credit worthiness of the business owner. So if the business owner has strong enough credit, then we can get business credit cards that don't report on the credit reports of the business owner, but start to report on the business credit profile, so we can build a strong business credit profile through business credit cards. So that's just simply an example of business credit cards do not care about collateral, and it's pretty much self-reported capacity. So that's an example of one of three C's. Capacity only. There's also lenders that are called revenue-based lenders. And in many cases, all they care about is capacity. Now, with revenue-based lending, they're not going to accept financial projections, that they want to see bank statements to see that the money is actually coming in. But my goal today is to create awareness of the importance of understanding the three C's and how it fits in, how it's typically needed. All three C's are needed for normal traditional financing, but we do have options with just one of the three C's. So we've talked about credit only financing. We've talked about capacity only financing. And then another, which we've talked about before, is collateral only financing. That makes sense, right? There's three C's, and we could have one of the three in access funding. Well, the collateral only is a unique option of these three, because when the business owner, the client, comes to you, either they have good personal credit or not. And if they don't, we can help them and we don't screen them out. But if they don't have good personal credit, we're not going to be able to just suddenly go get them business credit cards. It's not going to be immediate or near immediate. It would be a bit of a process. Now, if they do have stronger business, a personal credit, then we would recommend doing this, even if it's not their entire capital raise. Secondly, we can't just want a high deposit business. We're going to have, if we wanted to get revenue-based lending, we literally have to be selling goods or services to clients and typically having at least $10,000 a month in general of bank deposit. So we can work towards that, but there's not a way just to flip a switch and have that. However, collateral only, we can do that. Because, and I realize you might say, well, a lot of these small businesses, they don't have enough assets, but we can transfer the assets. We can't transfer credit. We can't transfer legally and ethically capacity, but we can legally and ethically transfer collateral that would allow any client to be able to qualify for a large business loan very quickly. So looking at asset-based lending a little bit more, and let me scoot this up. I want to delve into it a little bit more because we've talked about it before, but maybe I've not spent enough time validating it. So let's attempt to do that now. So according to the research that I found, asset-based lending, it's a big deal in the marketplace. Now, we're not talking about real estate. Sometimes some of you have a background in real estate. You say, oh, it's a hard money loan to get real estate. And I guess that's kind of an example, but that's really not where we're going with this. We're talking about more traditional business lending. So asset-based lending, it's a big deal. From what I read and researched, in the market right now, it's about a $5.2 trillion industry, which is very significant. And it's expected to grow quite significantly. The projections that I saw is over the next 2 years, it's expected to grow about by 50%. So tremendous growth. So it's a big deal. It's just a lot of small business owners and small business consultants and advisors haven't done much with business asset lending because most of their target audience, most of their clients didn't have enough assets to qualify. But what they were missing is what you and I can do. You and I can literally transfer the collateral to them so they qualify. So let's talk about KKR and some other players. So KKR, and that's what I know it as. I'm sure that's an abbreviation, but you could look it up if you want. But according to their information, they're really focused on growing their book of business of asset-based loans. They report that they already have 75 billion of assets under management. So they've got a lot of money to put into these asset-based loans. And it's a big deal to them. They report on their website, they have over 50 people that work in that department. So it's not just some little abstract, unknown, unimportant aspect of business finance. It's significant for some of these bigger players. And they most recently were published. I don't know if you read the Wall Street Journal as I do, but in a recent article, they were actually stated with this quote that they're looking at doubling down on asset-based financing, which in other words means they want to do a whole lot more of it. So it is mainstream. It is real. You can look up Chase, Bank of America. Most major banks have divisions. They have staff that's focused on this. So asset-based lending is real, and it's accessible through many different sources. So with that, let me open it up to the questions, comments, concerns you have as I kind of restate number 2, and then we'll move into number 3 for whatever you want to discuss. Anyone can get a large business loan, but we do need to have a fundable business. What does that mean? Well, we need to have the basics, but you and I can provide them the basics for free through a free shelf corp. That's part of what the grant provides. There is a processing fee, but that's how you're paid, and you determine how much that is. And then we will work with them to determine the strategy, because based upon their business plan, based upon how much money they want, based upon how they're going to spend it, we can help create, as well as their other mitigating circumstances, we can create the funding plan. And so that's a bit more complicated. So we're not asking you to do that. We're not training you to do that. We're not expecting you to do that. But that's what happens in what we often call phase 2, the funding portion. So we can look at their mitigating circumstances in terms of credit, collateral, capacity, and then work with them to determine, hey, where do you want to go with this? Do you want to go after a traditional business loan like an SBA loan? If so, that's fine. However, there are options where we only need one of the 3 C's. And so we'll start to evaluate, where are your strengths? Is credit your strength? Is capacity of your business your strength, or is collateral? And in many cases, these early stage businesses really don't have a strength in any of those areas. So the asset-based lending is a really good option because we can provide that strength. All right, so with that being said, I'm going to get into your questions, comments, concerns. So Kenny states, do you want a business simple or difficult to cause you time, delay, and funds? So I'll try to interpret what I think he is saying is that when we're going after traditional business loans that look at all 3 C's, it is more complicated, which it's okay. We all came from the SBA, so we can certainly do that. But there's more to get approved, whereby if we choose any of the options that have only one of the 3 C's, it's quicker to access funds. And again, it doesn't have to stop there. We could start and get someone business credit cards and get that right away as an initial tranche, and then still go back and go get an SBA. Or we could start with someone and get them asset-based lending and then go after other rounds. So it's not all in, one and done. But I think Kenny's point he's trying to share with you is that these are faster. We can get revenue-based lending in 24 to 48 hours. We can get asset-based lending often in 7 days. Business credit cards, we can get the approvals within a couple of days, but of course, getting the cards in takes a week or two. Whereby traditional business loans, it depends on the circumstances. We do have some express SBA loans that move through the system pretty quickly, but I would agree with Kenny that the asset-based lending is tough to beat. All right, so let's see what the next question or comment is. All right, so Selena's bringing up in terms of the foundational elements, and so all of you should be pretty familiar with what this includes, because if you are a reseller or a branch office, you have an editable version of our client agreement. You take our information off, put yours on, change pricing the way you want, so it clearly states what the deliverables are. We provide them an entity in good standing. We provide them for free a unique commercial address. Now, they will pay for the mail forwarding, and that kind of makes sense, right? Because they're working from somewhere else. Their mail's going to their business, their unique commercial address. So, of course, we need to get the mail from their commercial address to where they are. But all we do is just do pass-through cost of forwarding the mail. So that should not be an issue. The business plan comes pre-done, and I think that's kind of Selena's point. We already have the business plan. It's delivered to the client with the shelf corp. Now we can go in and make changes to it, of course, but it comes kind of like a business in the box, as does the financial projections. So we're making it really simple for them to have through the shelf corp to have that foundational element ready to go. It doesn't require time or effort on their behalf. Then we need to work with them to say, okay, is that good to go? Or do we need to make any changes based upon what they want, especially the use of funds? All right, so hopefully that addressed your question or comment, Selena. So Brian's asking about the ABL. So that's right. And what we've covered, we're very transparent. So let's go ahead and add some comments or notes to this to get everyone caught up, because Brian might not have been on the prior trainings. And also, just so you know, there's a full training on asset-based lending right here. If you see, I'll highlight, I'll lose my notes, so I'll pull it back up. So this is a full training on ABL, just so you know. Okay, but let's go back. So let's highlight a few points. So asset-based lending is popular in the mid and large markets. It's for businesses. It's not as popular in the small market because in many cases there's a 1 million minimum. So typically, if we're not going to go after $1 million or more, asset-based lending is usually not a good option. And again, you might see that number and say, well, that's difficult, right? Because my clients don't have that much assets. But what did we say? We can provide that. So that gets to Brian's question. So through the grant, we can provide $1 million of collateral, which is in the form of AR, which we'll talk about in a moment. And we provide that for 1%, which is well below the market price. It's subsidized. Now, if you want to mark it up, you can mark it up. We've got Ben's on here. Ben sells his for 5%. So he's making 4 points because this is what our cost is to cover our cost. Anything above that is yours. And so that's obviously $10,000 for every million. So in Ben's case, and he has a more complex organization, but he's literally making, I guess, gross income, $40,000 per client on the collateral exchange. Now, if you don't want to mark it up, you don't have to mark it up. That's up to you. But Brian was asking specifically about the cost. So it's 1%. The answer is 1%. Now, what I see Kenny bringing up, and that's where I was going to go next, is by transferring this AR, then if the client wants us to, we don't have to, but if the client wants us to, then we can liquidate the AR because it's real accounts receivable. Well, what happens when we liquidate that 1 million of AR? Cash flow starts coming into the client. Now, all of a sudden, we have met the second of the three C's. So the collateral comes right away. And then as we're collecting the money, we're licensed, bonded, and insured as collection agency, debt collection agency. As we're collecting that money for the client, now we're creating cash deposits. Now that's going to open up a whole nother round of funding that they would qualify for. Plus, in many cases, us just liquidating the collateral, liquidating the AR will be enough to cover their monthly payment for the business loan. So it's crazy good if you understand it. All right, and let's see. Amanda's bringing up a good point. Yeah, so there are reporting requirements when you get into asset-based lending, but we'll take care of those. So if you're using our asset-based lending platform, we'll provide the collateral and we'll take care of the reporting. Okay. So Doug's bringing up a point that I covered before, and maybe I needed to take a deeper dive into asset-based lending for those of you that may not have watched the training. But yeah, one of the great elements of asset-based lending is it's unrestricted, and that's what he's getting towards. So what does that mean? It means that the money comes in and it can be used for whatever. It could be transferred to another company. It could be used for anything. It's unrestricted. So unlike an SBA loan, which is back up here where there's restrictions of what you can do with it, when we get to asset-based lending, it's unrestricted. And so we've talked about advanced strategies of using two different companies. One company to get the ABL and then another company to buy real estate. The company that's buying the real estate's buying it as a cash transaction, and it has no lien against it because it's the other company that borrowed the money through ABL. But I don't want to revisit all that. You'll see that on the ABL training if you need. All right, and then Landers is asking about the liquidation. So yeah, let's dig into that. So what do we have? If a client is going to use asset-based lending, they're going to need collateral because that's what it's based off of. We can provide that, so we understand. And so then what we said is we can liquidate. So what that means is, again, we're licensed, bonded, and insured. It means we're going to collect the money owed from the debtors, the people that owe the money, to get money into the creditor's hands. And the creditor would be the client in this case. So we do the normal things you would expect a collection agency to do, whether it be call them or send invoices and demand letters, threaten to sue, sue them, litigate, get post-judgment collections, get an attorney, a law firm involved with the receivership. So there's a lot there. But the beautiful thing is you don't pay, or the client doesn't pay us to liquidate. Instead, we add the collection cost on top of the principal amount. So ironically, it's the debtor, the people that owe the money to the client, that's actually incurring our collection cost. So it makes it a really good deal. The exception to that would be we do need to cover the court cost. So if we're going to sue someone, the court is going to charge a court filing fee, and then we have to have the debtor served, which could be a sheriff knocking on their door at work or home, could be a private process server. So there are costs involved with liquidation, but the great news is those costs are pushed off to the debtor. So not only does the creditor, who's the client, get the money that's owed, the debtor is incurring the cost of collections and legal fees. Hopefully that helped. All right, with that, we're running a bit long, so let's just wrap it up. Again, if you need individualized support, recommend texting us 903-347-8042. We've reiterated the 3 mandates of our nonprofit and the grant. We've focused in on, it's not a mystery, it's not difficult, it's not going to be impossible or really even that complicated for anyone to get a large business loan. We just need to understand how the model works, how the system works. And the system starts with, we need to have a fundable business if we want business funding. But the good news is you and I give away Shelf Corps to provide that. Step 1, phase 1. And then step 2, we're going to work with the individual client to determine what specifically they want and need and qualify for. And if we're going after traditional business loans, that's fine. That's going to typically involve all 3 C's, credit, collateral, capacity. But there are funding options with just one of the 3 C's, and we can help them with those as well. All right, thanks everyone. We'll see you back tomorrow morning. Have a great day. Appreciate your time. Bye-bye.